Imagine closing out the fourth quarter and the numbers look spectacular. Revenue is climbing, margins are wide, and growth is compounding at a clip you've never seen before. You sit down on a Friday to authorize a standard payment run to your key suppliers, but the transaction bounces. You check the accounts, and the balance is virtually zero. This graphic illustrates the exact trap. You can have a perfectly healthy green profit metric on the left, but an empty cash display on the right. You are overwhelmingly profitable and completely illiquid at the exact same moment. This visual shows why. Profit is an accounting opinion, shaped by accruals, estimates, and executive choices. Cash is a cold, hard fact. A dollar either landed in your account or it didn't. There's no negotiating a bank balance. Relying on the income statement alone gives you a false sense of security. Because if you only watch the profit line, you are flying completely blind to an impending cash crisis. So, if the business made money, where did it actually go? The capital didn't disappear. It underwent a physical transformation. This model breaks down exactly where that capital gets trapped. First, look at the raw steel sitting in the yard. You've already paid for that material, but right now it's just gathering dust. Next, look at the work in progress on the factory floor. You've poured labor and machine time into half-finished products. They hold value, but you can't bill a customer for a gear that's missing keys. Finally, there is the accounts receivable trap. You deliver the product, but the customer takes 90 days to pay you. Meanwhile, your own suppliers demanded payment in 30. That 60-day gap drains your liquidity. This diagram lays out the math behind that delay. It's called the cash conversion cycle. You add your days of outstanding inventory to your days of outstanding sales, then subtract the time you take to pay your own bills. Every single day a product sits in a warehouse, and every day an invoice remains uncollected, you are essentially lending your own cash to your clients for free, and that generosity will bleed you dry. Counterintuitively, a business is rarely more vulnerable than the exact moment it starts winning big. To fulfill a massive influx of new orders, you have to buy immense volumes of raw materials up front. You are forced to drain whatever cash reserves you have today just to pack the warehouse. That heavy capital expenditure hits your accounts immediately, but those new clients won't actually pay their first invoice for another 3 to 6 months. This chart shows the exact mathematical consequence of scaling too fast. Watch what happens as the green sales line spikes upward. The physical cost of servicing those new sales pushes the red cash reserve line straight into the negative. This slide highlights a trap most founders never see coming. A business can literally grow straight past its own cash reserves, which is exactly why highly profitable, fast-growing companies frequently go bust. Unchecked growth acts as an accelerant. It burns through your operational oxygen long before the promised profits ever arrive. Surviving this requires stepping away from the income statement and executing a series of highly unglamorous operational fixes. This slide outlines the necessary steps. First, you have to tighten your terms and conditions. You must forcibly narrow the gap between the day money leaves your accounts and the day it comes back. The second step is liquidating stagnant inventory. Steel sitting in a yard is doing absolutely nothing for you. You have to sell it off, even at a slight loss, to convert that physical mass back into usable liquidity. Third, you chase down your receivables. An unpaid invoice is a loan you never agreed to make. You have to be relentless about getting your clients to pay on time. There is no clever financial engineering here. These are the harsh, mandatory disciplines of business survival. This graphic drives home the ultimate rule of corporate finance. You cannot hand your employees a piece of a net income statement. You pay payroll with cash. Profit proves that your business model actually works, but cash determines whether you survive long enough to reap the rewards. It's a brutal reality check for a lot of founders. So, what is the hardest lesson you've had to learn about the gap between profit and cash? Let us know in the comments.